For more than 50 years, Mario Gabelli has maintained a rigorous stock market investing discipline that transformed him from just another smart kid from the Bronx into one of the world's most prominent billionaire investors and money managers. The process for the 81-year-old Gabelli starts with a deep dive into a company's financial statements, followed by talks with suppliers, customers and competitors, as well as face-to-face meetings with management. He was on the road to Melville, NY for such a meeting less than 1 week before Christmas and eager to kill time in Long Island traffic talking about the January effect, the propensity for stocks to produce outsized gains during the month of January. Typically associated with smaller stocks and those that have incurred big recent losses, the bullish tendency of stocks in the first month of the year is sometimes explained by tax loss selling before year's end and subsequent bargain hunting by investors in the new year. As the year winds down, people talk to their tax guy and say that they want to realize some of the big gains they've made in stocks, and their tax guy points out the tax impact and tells them to look at their portfolio to find some of their losers where they can realize unrealized losses, says Gabelli. That's going on fairly extensively now as people look to lock in gains on Magnificent Seven stocks, for example, and harvest losses from things that didn't work out. That's a logical explanation, but historical returns around the globe show that January buoyancy occurs even in stock markets of countries with different tax calendars, or no capital gains taxes at all, so there is more at work than just tax loss harvesting. Another major factor is cosmetics, or the so-called window dressing phenomenon, says Gabelli. Mutual funds don't want to be stuck with a bunch of big losers that they need to list among holdings in reports that they send to their investors, so they get rid of them before the end of the year. The January effect was first documented in the year that Gabelli was born. In 1942, 24-year-old New York University economics and statistics student Sidney B. Wachtel wrote an article titled, "Certain Observations on Seasonal Movements in Stock Prices," published in the Journal of Business of the University of Chicago. Wachtel, who went on to a career in investment banking and served as a Treasury Department economist under President Eisenhower, chronicled a persistent bullish bias for stocks between December and January for the 1927 to 1941 period. In 1976, a generation after Wachtel's initial study of January returns, Michael Rozeff and Willian Kinney Jr. added more empirical and academic heft to the January effect, showing that the average monthly returns from 1904 to 74 for an equally weighted index of New York Stock Exchange stocks was 3.48% in January, compared to 0.42% for the remaining 11 months of the year.